All right, my first guest has been bullish on its AI for some time, actually pushing back on this sort of nonstop negative commentary and assumptions. Let's bring in now UBS Private Wealth Management Managing Director, Alli McCartney. Alli, okay, so you're saying the AI story is actually getting stronger.
I think it's getting stronger. I think that if you look at other transformational technologies, whether you're talking about the railroad, telecom, electrification, you're talking about CapEx spending for a significant sustained amount of time of 2 to 5%. We are at 1% for AI. AI right now, or the NASDAQ full stop, right, trading at 29, 30 times forward earnings. If we go back 26 years to the peak in 99, those numbers, even for Microsoft, were closer to 80 times.
Yeah, we're going to put a table up of that in a second, but I do also want to underscore, you talked about, let's go back there for a second, the confidence that AI investors, yeah. I mean, we're talking billions of dollars. These aren't dumb people. You don't get, yeah. You don't get your hands on $100 billion if you're dumb, right? You kind of know what you're doing. Adoption is picking up here, and the return on investment, this is what I wanted to ask you about, because this has been the sort of thing, I guess a month ago, MIT had that study, and only 5% of companies are making money with AI. No.
That is no longer. So I've just been through a cycle with my own clients. And remember, many of my clients are the CEOs of these kind of companies.
Right.
And so I get to see a little bit the, proverbial behind the kimono. There is a lot of real savings, increased profitability, and margin going on. Let me give you two examples that have been publicized this earnings season. The first would be JP Morgan talking about pitch books and how quickly and succinctly they can make them.
Right.
The second would be what we're hoping to see this week, which is the micro earnings story fueling this rally that we're seeing this week, which is, we have companies, Google, for example, saying that their cloud revenues are up 25% year over year. And why? That's demand, electrification, storage necessary from these big compute models. So what I think that people are going to be looking for this week as 5 of the 7 mega cap come through is, what is the adoption looking like?
Right.
What's the return on the investments made? And can they keep that level of investments up?
And you feel like we'll be checking all of those boxes, yes?
Look, we're not going to check it for every one of those companies,
sure.
But we're going to
start
to see a trend that says, look, there are excesses in certain companies or certain places, but are we at 80, are we at 80 times forward earnings just because money's getting a little cheaper? I don't think so.
Let's talk about the broad market.
Yeah.
Looking for S&P 500 at 7,300 by next June.
Yeah.
You've talked a lot about this, fiscal policies, monetary policies. The Fed is your friend, and so does the federal government. Better than expected GDP growth. Let's stay at that for a moment, because that's been somewhat of a surprise for a lot of people.
So, for example, when we saw last week's September delayed CPI print, which I think gave birth to this week's boom,
right,
which is both on the micro, the earnings, and the macro, the Fed getting permission to keep on going, part of that was that these costs that we are waiting to see show up in CPI from tariffs has been less than companies or people expected. That's also been coming through in earnings. It's not to say that we're not going to continue to see inflation. It's not going to say that 3% isn't the new 2%,
right,
but it's not posing the kind of worst case scenario problems that are going to threaten the directionality of both GDP, so continued growth, and Fed easing.
We saw Ford was up 13% on Friday. GM was up 15% in one session. Alcoa was up huge. All of these names are supposed to get hammered because of the tariffs. Attractive sectors for you: IT, utilities, healthcare, financials. Let me go to utilities for a moment. Ironically, they were a little bumpy last week. Is it possible that utilities could be ahead of themselves, the safe haven of all safe havens?
So let's talk about whether it is a safe haven. And I think more than a lot of these spaces, utilities are not created equal, right? So there's some that are benefiting from the AI revolution. There are some that are either benefited or losing from the rates game. There's some that are benefiting or losing from geopolitical instability around oil. So that one, I think, is a tough one. I wouldn't buy it on the sector level. That's where I would get specific about stocks. Healthcare, to me, is the most interesting one,
really,
because we are finally, after 10 years, starting to see not only some bullishness about policy in Washington, but also sort of end use and the monetization of a lot of health tech and technologies.
And global equities, you just raised to attractive, right? I have 30 seconds, so I want to ask you about the Fed. Yeah. How many cuts are you seeing this year and next year?
I think we have 2 this year, 1 or 2 next year,
okay,
which hinges on which is why I'm so disappointed not to be here and be part of this discussion
tomorrow's going to be phenomenal.
How many seats he gets, the administration can get in there, and so the heft of moving forward with rate cuts.
And gold, 4,700 next target.
Look, I think the pullback we've had is a great opportunity to buy. There's been, people have taken 65% year to date, so obviously there's something coming out of that, but central bank buying, lack of faith and credit to a certain extent in the U.S., and decreasing opportunity costs where interest rates are concerned, and we saw, you may have seen, some news out of Israel earlier on.
Right.
So I think that we've taken a breather on gold, but I fully expect that to resume its upward climb.
You've been crushing it. Thank you so much. Always great. So I'm going to miss you tomorrow, but always great seeing you today. All right, folks.